Hello, and welcome to Network Effects and Flywheels in DeFi for Institutions. Today we're going to be chatting about the kind of recent rise in institutional interest in DeFi platforms and how platforms are kind of evolving to meet those needs. We have four panelists today. We have Brian Norton from MyEtherWallet. We have Aya Kantorovich from FalconX, Konstantin Richter from Blockdaemon, and Imran Khan from the DeFi Alliance. Welcome, everyone. I just wondered if we could quickly go around the room and just introduce ourselves beyond that, and yeah, maybe kind of briefly chat about the topic on hand. Brian, do you want to go first?
Sure. My name is Brian Norton. I'm CEO of MyEtherWallet. I've been with MyEtherWallet since 2018. For those who are not familiar, MyEtherWallet is one of the oldest interfaces for interacting with the Ethereum blockchain. We started in 2015, about a month after Ethereum. And since then, we have gone through several iterations of our popular web interface. We offer mobile solutions, and we have recently introduced some cross-chain compatibility with other EVM chains. And basically, what we are a user experience solution for users looking for a non-custodial solution.
That's brilliant. And Konstantin?
Yeah, hey, I'm the CEO and founder of Blockdaemon. Blockdaemon is 3.5 years old. We're a node operator. We're the largest node operator in the world. We run 15,000 full nodes across 40 protocols. And we really do two distinct things. One is we offer single command line APIs across protocols to pull and push data, mostly for institutional customers. And then we run financial institutional staking, right? And so really underwriting and facilitating, a large scale adoption of staking via really B2B to B2C, for large financial providers who need intermediaries like us in order to, settle that type of stuff. And we're based in, I'm based in the Bay Area. Nice day today, a little smoky, a little bit of fire in the air, which is how we like it. Happy to be here.
Brilliant. Aya?
Yeah, thanks so much for having me. So my name's Aya. I lead institutional coverage at FalconX. FalconX, we are a cryptocurrency financial services company servicing institutions who want trading, clearing, and credit on our platform. So super excited to dive into DeFi today.
Brilliant. Imran?
Yes, Imran, one of the co-founders and partners at the DeFi Alliance. We are an accelerator platform that helps startups source liquidity and build community, and then along with that, align with the broader institutional adoption. We've had over 80 startups that went through our program. We've been in operation for over 2 years, and we're announcing a new program today, which we're very excited about.
Awesome. All right. So the main reason why this event is sort of so topical right now is essentially DeFi has kind of really picked up in pace. It kind of really came to the fore last year. And we're now starting to see bigger kind of institutional investors start to say, can we get involved in this? Can we access this? And whether or not they can do so in a compliant way. We're starting to see platforms bring out compliant offerings and try and service these investors. So let's start with the basics. So can someone come in and explain what DeFi is, just on a really simple level? Who would want to do that?
I mean, I can give you my tilt as the probably least financial person in here, because we're really an infrastructure company, right? And so what's been interesting for us, we've been sort of thrown into becoming a fintech company over time. And so we started out really as a developer tool. We became a sort of SaaS platform to enable institutional connections into blockchains. And at this point, over the last year and a half, we've built up substantial treasuries. Partly our revenue models live on transaction volume as well as yield generation. And the way I always think of DeFi, because staking sort of falls into that to some extent, I think the definitions are sort of vague, but anything that allows you to do what a bank does in a decentralized manner, right? Which is ultimately when you go to a bank, you put money somewhere and you ideally, if you're lucky, get some interest on what you have. You can ask a bank for a loan, and there's different collateral that you give, and all that stuff happens in the DeFi world. Ideally, in a decentralized manner. I think the big touch point, and the one why this discussion here is complex, is I think a lot of people associate the independence of KYC and AML with DeFi, right? And so there's this sort of expectation of seamless enablement that I have a token, you don't know where it is, I can borrow against it, or I can earn interest against it. And so the question that we always find really curious is, how do you combine both, right? Like, how do you allow people to earn interest on crypto on existing DeFi tooling where you have the Uniswaps and all those type of things, and how do you kind of build bridges here? But to me, that's what DeFi is ultimately earning yield and asking for credit using crypto as the main collateral. I don't know if you guys agree, but that's sort of my interpretation of it.
Yeah. Anyone else want to come in on that?
Yeah, I mean, I agree with Konstantin. It's really the ability to build new products that allow new types of interactions using layer 1 blockchains like Ethereum and Solana. Some of the things that we're seeing today are like essentially like leveraging smart contracts to allow new types of products to be being built. So you're seeing, lending, where traditionally you would actually walk into a bank and get a loan out, right, or require or ask for a loan. Today, you could just leverage the assets that you have, deposit the assets, and then leverage that as a way to borrow against it, all using smart contracts. So you have smart contracts that facilitate all of the transactions that go between what the smart contract requirements are in terms of risk, in terms of the collateral size and the LTV. And that's incredibly important in the world that we live in today. I think someone I saw like an article around 6 months ago that tried to describe DeFi from a very traditional sense, and essentially they say like it's self-driving cars, right, or self-driving banks. Mm-hmm. And that's kind of the way the viewpoint that I would look at it is that you have a layer 1 blockchain like Ethereum, Solana, that facilitate new types of behavior using smart contracts. And smart contracts are essentially recreating financial intermediaries that we live in a traditional sense, and then they enable the same type of behavior and products that we're all looking for.
Yep. Okay. Thank you. And what's the current state of institutional adoption in the DeFi industry right now?
Yeah, so I can speak a little bit to this. I would say there's definitely two sides to the coin. On one hand, you have institutions who have been able to get, well, first off, I would define what institution is, because we love to use that word in crypto and it can mean a lot of different things. So if you're a family office, if you are, let's say, a sub $1 billion fund, if you are a venture fund, if you don't have a board, or if you don't have a certain size of limited partners on your cap table, there are certain things and risks that you are able to take that perhaps asset managers, other asset managers, or larger or more traditional funds can't. And so what we're seeing is on certain traditional financial funds, even for us, we have clients who are $1.5 billion asset managers, all traditional finance backgrounds who are getting very actively engaged in DeFi tokens. I don't think that narrative is shared as much as it should be. I think I saw a quote somewhere on Twitter where 99% of people still don't know what Solana is, but we are seeing a lot of institutional investors get involved in Solana. And the way they can get involved, whether it's through FalconX or another intermediary, is by taking a position as you would as a shareholder. So in the entire way of getting decentralized, you can buy these tokens and take basically a venture position, a momentum position for if you're very bullish on the product. On the other side, and I'm sure we'll touch on this, is folks who can engage directly with the intermediaries themselves, whether it's the Uniswap or the Aave, things that Fireblocks is building today in terms of solutions to be able to access these that allow the liquidity to be KYC'd primarily as it consists on the Patriot Act. So making sure that none of the assets come from terrorist accounts, and they're all KYC'd. But I think, even if you look at just the numbers, total value locked for DeFi, I think I looked at it this morning, it's $84 billion. The height was 87, so we're almost hitting all-time highs. And if you look at even just like Ethereum versus Bitcoin dominance, that's changing, where Ethereum's going up, Bitcoin dominance is continuing to go down. And these numbers are big, and they happen because you have large institutional pockets funding the space. And the last thing I'll say is probably the number one call I get from institutions is, how can I get this level of yield? So Konstantin, you mentioned this too. Hopefully at a bank you're lucky if you get a yield, at least today, right? Money markets are returning like 0.5%. And so like, if you look at even like a convex finance, or even the incentive programs that have just been rolled out across 4 different protocols, there are significant amounts of yield in DeFi that institutions want to get a hold of, especially if they have the risk appetite to be able to access this directly.
And maybe let me just top that up a little bit. So I think what we see also on institutions, so there's different types of institutions, as was mentioned. So there's crypto native ones. You have the Krakens, the Coinbases, the BitGos, the Anchorages, right? So you have the current crypto native sort of banks, right? And so then you have the traditional asset managers, and then you have the traditional banks, right? And they all sit on a different spectrum, I think, in terms of how they are thinking about touching and integrating and offering certain services to their constituents. I think on the crypto native side, obviously the discussion is a lot more advanced. Like the large scale exchanges make investments directly, might build integrations on it. We build integrations into solutions like Uniswap and other bits for our customers, so they can access different liquidity pools. Customers there, again, very crypto native, very crypto heavy. I see a lot happening in institutional adoption with liquid staking. And I think that'll touch the more traditional digital providers, the sort of, kind of Robinhood-like entities who, if they allow their customers to hold Ethereum, for example, by next year, need to probably figure out how to offer interest on that if they want to continue to offer compelling wallet infrastructure. And so I think you see a lot more interest on entities from that side. And then, you have on the asset manager side as well. I mean, yeah, we see a lot of interest there from large institutions as well. I mean, we have customers and partners like Goldman Sachs and stuff who are building fairly sophisticated infrastructure for their own asset managers to kind of start experimenting with it. But it is super early for those guys. So there's a lot of questions that still need to get solved, and the stack is a mess. I mean, there's a lot of different components to doing this efficiently that the institutional non-crypto native customer base is really struggling with, which is why I think we're all here, because it's a big opportunity as a potential market.
That's definitely true. Would you say there's been an increase in interest from institutional investors over the past few months, or can you kind of quantify how that's changed?
Yeah, so I think we probably get upwards of like 10 to 15 inbound institutional client requests a week, which was not the case previously. I mean, at this point, even if you look at anchoring on like Coinbase's institutional client numbers from their quarterly earnings from Q1 to Q2, that jumped significantly in size. There is absolutely no doubt that institutions are getting more involved. If you even just take, like the block and the articles you've written on institutions like Citibank, notably, they're getting more involved on the future side where they don't hold the underlying, but those institutions starting to have these conversations, that's also accelerated. So it's definitely happening in size. It's pretty exciting. I don't think anyone's highlighted, I think, how fast it's happening, and, unclear if that'll continue to happen tomorrow, but today, that's the case.
Okay. And Konstantin, have you had much interest and obviously kind of demand for infrastructure services from institutions, and has that kind of demand changed recently?
Yeah, I think, we're again, we lay really big pipes for people, and so the stack, I think, for DeFi is really up in the air around different components, custodial, infrastructure, settlement. Like there's different one-stop shops. There's different ways people stack stuff up. And where we see actually to that point, like for us, the most long-term interest we see on the investment side, actually. So we have investments from like top 10 to top 100 banks, which is interesting. You know, we're a business that makes most of its money via tokens. And so we felt, for example, when Goldman Sachs came on as a strategic investor and partner earlier in the year to us, that was actually a fairly big deal. We were the first investment they've made into an entity that earns, 25 different tokens in yields as revenue. And so, I think that's a good indicator of some of the larger institutions really diving into this segment more. And we see that continue throughout our sort of capitalization growth over time. And so we'll announce a few other top 10 banks. We're sort of curious about it, let's say. But I think and so I think the biggest change obviously sits within ETH 2.0. I feel like that's been a real big enabler for a lot of the discussions we've been having, just because it's obviously a massive transition from a proof of work to a proof of stake protocol that potentially enables very substantial yield earnings with really complex market economics, 1-year lockups, et cetera, et cetera. And so the structure of underlying products and derivatives for institutions is going to drives a lot of the conversations we have around ETH 2.0 specifically. And so I think that's heating up and accelerating all the time because ETH 2.0, if you understand the economic reality of what that looks like, then if the merge happens successfully, and this is a complex technical undertaking, it's kind of like two trains and different speeds trying to connect to each other. But if it does happen, then I think the largest flow of digital assets will incur there, and it'll be the largest mass adoption of a DeFi type product we've seen to date. And I feel that drives a lot of the attention that we see.
Yeah. Okay. And Brian, we've heard recently about MetaMask providing institutional access to DeFi via MetaMask Institutional. Has MyEtherWallet been doing that kind of thing or anything similar?
At this point, we're still very much focused on the retail market and servicing individual users, small institutions, things like that with custodial solutions. And there's a couple of reasons for that. And some of them have kind of been discussed and kind of touched around. I have mentioned a couple of things that alluded to that. The biggest reason I would say is institutional appetite historically. We've been around since 2015. I've been with the company since late 2017, early 2018. And in that time, we have had several discussions that with potential partners who want to work with us to create institutional solutions. And those and everyone's very excited, and there's a bullish sentiment around institutional adoption. And then coincidentally around certain dates, say October 2018 or April 2020, those conversations start to cool. They cool with the market. Their backers get a little bit skittish, and we've seen that pullback. And so what we've kind of learned from that is the market needs to stabilize, and we're part of that. We're part of like creating that infrastructure that makes that a reality. And I think we're beginning to see that now with this increased and sustained institutional interest that we're starting to see now. The other reason is that the purpose of the wallet is, wallets and other non-custodial solutions is to empower users without the use of a trusted third party. And I'm not saying that institutional requirements like AML, KYC, those things all have their place, and we are definitely looking to create those solutions. But it does run a little bit counter to what the core function of what a wallet and what blockchain really does. And so that focus on the user and individual empowerment to maintain custody has to be our sort of core drive. Where our job is really to make the blockchain usable, and nobody who has interacted with a dApp this year or this month or last week will tell you that those problems have been solved. Like those pain points are still very, very real. And so we have a lot of work to do to maintain that security, maintain that understandability for users on the retail end, and then work backwards towards institutionals. Because what we don't want to do is go after the shiny object where it's like, okay, we can kind of kick the can down the road on all of these really pressing UX issues because institutional investors are coming in. You have a lot of high value clients who are going to be working through custodians. So becomes no longer our problem to solve. And that might work for individual projects. It might work, it might be very lucrative in the short term, but it's not going to help sustain the ecosystem. So that's kind of where we're at right now.
Yeah, can I just say one thing also about MyEtherWallet, which I find like obviously such a cool project. You know, it's been one of the really early ones. I remember using it to, kind of do my little gas fee calculation for Ethereum, like back in 2016, 2017. And it's been such a staple. And I do feel like this is such an important point, right? Which is, and we think about this a lot, like Blockdaemon obviously is a huge problem in some end where, because we write and run so much institutional infrastructure, we don't want to be also just a sort of enabler of the current sort of financial infrastructure solely, right? Like you need both, right? Like I think the philosophical question we always answer is, and we've settled more on the institutional side. We used to be a lot more individual, mostly because that's the side where we can commercialize most of our offering and we're VC-backed entity, and that's just the world we sort of live in. But I also fundamentally believe that the biggest mass adoption of this will come via legacy rails. That to the end what Aya said, like Solana is 99% of people haven't known it. I think people will earn yield on Solana before they know that what Solana is, probably via institutional third parties over time. And so you kind of need both a little bit, but I totally hear you. I find it such a conflict, like I'm constantly baffled by it.
I think that I think that you absolutely do need both. And I think that because this group is coming from it from so many different angles, like we're all coming from it from a very different vantage points, and ours being UX, being UX, I was like, we do not see a future for like sustainable institutional products unless we go work backwards from consumer facing, because the blockchain is immutable and it's scary. It can be scary, and so and mistakes are permanent. And so creating like being able to create these sort of user experience that can work, that can coexist in both worlds. It doesn't have to be fundamentally contradictory. Like you can have individual financial freedom and still create compliance solutions. They just need to work. They need to be user friendly, and they need to be interoperable. And so that's.
But how do you handle a risk like I think the problem with that type of setup is the non-crypto sophisticated investor falling victim to a bug in a smart contract and suddenly losing all the assets, right? And so like that gets more complicated, right? Like that's fine if you're like an insane crypto lover, hedged 15 times, you know exactly what you're doing. But how does that work for someone who suddenly has substantial loss and they have no means to understand what occurred? They relied on a provider to manage their individual custodial structure, and the smart contract itself has an issue, right? Like, so that's the other part that institutions do normally. They provide liability and insurances to some of these services. So more like a question really, maybe for Imran. Also to kind of, I'm curious what you guys think at the DeFi Alliance about all this stuff.
Yeah, we work pretty closely with trading firms and market makers, and the way they think about DeFi is, kind of two ways. One is, there's this like looming regulatory landscape, and they have to be very careful in regards to how they provide liquidity, how they're using these platforms, especially derivative platforms. And then, if you think about some of the newer innovations that are coming out and that are providing substantial yield, they have to think about it from a security perspective as well. And so the two things that we see that are top of mind for most market makers and trading firms is security and then regulatory landscape. And so the premise behind Solana excites market makers specifically, and I'll tell you two reasons why. One is, from a throughput perspective, it's it's much more quicker in terms of the types of transaction that they want to do, right? So that's number one. Number two is there's a lot of institutional adoption happening on Solana versus Ethereum. And you could see this from Jump Trading just established a company called Pyth, which is essentially an Oracle provider that provides data streams from larger public market equities firms or public equity exchanges. Along with that, they're working with all of the market makers to provide the actual data inputs, which is very interesting. So what we're starting to see is kind of like a divergence in terms of where institutional adoption is happening, along with where you could see where the community is going. A lot of the innovation that we're seeing is still happening on Ethereum, and then a lot of the institutional I would say sandbox tests and kind of protocol developments are happening on Solana. So this is just like a great A/B test, I think, because we're starting to see a way to onboard more institutions into something like a Solana, whereas we're starting to see more and more folks that are more community-driven, more innovation-driven happening on Ethereum.
I'll add two more names in there. Luna is another really hot layer one, an ecosystem, Terra, that's building a lot of steam. Imran, you mentioned to those same 2 points. And then Avalanche as well, and just Polkadot. I know that was one of the questions that was asked, especially with Kusama kind of building out and continuing to launch more projects and test. That's gained a lot of adoption. But it's almost, and I'd be curious to get your thoughts, how much of these incentive programs are part of the reason that you're seeing, so much of this interest and adoption versus obviously, the 2 points you mentioned.
Well, what's interesting is that, there's so many use cases. I mean, if you just look at what's happening in the Web2 world, what you could build on the internet is unlimited. And so now if you recreate those products on all the layer one public blockchains, I think there's enough business for all the layer ones to, substantiate all of what's happening on Web2. So an example is if you look at Celo is purely focused on mobile-based applications. And that's a great use case. And we're starting to see a lot of emerging countries, third world countries are building for those types of use cases, which is how do we bring DeFi to the masses? So that's number one. I'd say between Avalanche, Polkadot, I'd say that there's a lot of excitement from a geography perspective. So you're starting to see more folks from India and China that kind of gravitate towards Polkadot and Polygon, where we're starting to see, other kind of geographies gravitate towards other kind of layer ones. So we're starting to figure out what product market fit looks like from a global perspective. And we're starting to see more and more of this happening. Now, on the incentive side, I think incentives are a great way to bootstrap community early on, but the goal is always how do you retain those customers after the incentive is gone? And so this is the theoretical question. And I think that's what we're going through in terms of experiment. We're starting to see some of that success happen. So the first layer one to launch this was, I think it was Polygon. And when Polygon launched it, at first it was kind of like a pullback in terms of what the community thought could happen. And then after the incentives kind of tapered, we started to see a lot of the founders that actually stayed back and started building. So I do think to a certain degree incentives work, bring on new developers, but the question is how much of it can you keep when incentives are gone?
One thing I also want to just highlight because
now we just had a bunch of smart contract platforms being named. What does the panel think on kind of Ethereum's current status as the kind of home of DeFi, and whether or not we think other platforms are going to come and take some of its market share.
Yeah, I just want to, just because, you know, we run a lot of the critical infrastructure of a lot of these projects, obviously, in terms of the key validators and stuff. One thing I want to highlight, just because I always find it interesting and personally, that all these different networks obviously really only differ in terms of how they're, technically, they're actually not that different. They have different combinations of software, storage functionality, and ultimately peer connections. And it's a little bit like these kids' books with robots, you know, where you have 20 heads, 20 bodies, 20 legs, and you kind of sort of flip them around, and that sort of gives you the different protocols. And then they all have different investors and liquidity strategies and go-to-market strategies. And some of that is regional, some of that is global. I think we've always found it interesting that, you know, some of the best technical projects don't get the traction they deserve just because they lack the ability to market make and build a community on that side. And so you need both, right? You need really heavy pockets. You need technical feasibility, even though that's not actually a must. It seems like we've seen protocol scale with terrible technology. And so I find it, but I think the sad reality is that the money that is pumped into the system is a really important factor in order to incentivize certain behaviors. We think, and you know, I also want to break a leg for the parachains on Polkadot. I think that's a really interesting product and a really interesting way of going about it. I think that said, personally, I think Ethereum with the ETH 2.0 shift is going to be it's such a fundamental evolution. If it happens, it'll really reshape the landscape completely. I think the flavor du jour obviously is Solana. I think it's been fascinating to see how they've managed to really build up excitement. And that's partly because FTX is a big player in it. They know how to build a market, how to pump liquidity, and they're very smart. Technically, the Solana team's been outstanding. Polkadot's been really smart. And so I think those are the projects that have the technical chops as well as the billions and billions of dollars to potentially compete with something like Ethereum. Terra was mentioned, Luna. Also is a very, you know, is an outstanding Cosmos Tendermint variant. I think IBC is a super interesting product there. They've struggled with getting liquidity on an institutional level into the market, but Terra sort of solved it by being a real used payment provider. And then you've mentioned Cielo. The other one I want to mention that I really love is MobileCoin, which is the sort of in-app payment system for Signal that you know is an interesting platform. That can also run quite a lot of different potential DeFi angles if they can entice the community appropriately. But community is such an important factor. And currently Ethereum is, you know, I mean, it's not, no one else is close, you know, like there's no developer community on Ethereum's level, I would say.
Well, so I actually think kind of differently. I don't think it's a one-size-fits-all model. I definitely think in the same way that like Google won search, YouTube won video, and Facebook won social, that you'll see different protocols win specific niches. And a lot of that is actually, Konstantin, what you mentioned, go-to-market is a huge part of scaling any company, whether you're decentralized or centralized. I agree with
that statement, by the way. Like I totally agree with that, like for sure. I just meant on how they compare to Ethereum, but I agree that there's going to be multiple different versions for different use cases, regions, all sorts of different bits. I agree.
Yeah, because, well, even the ETH 2.0, right? Like the expected timeline for that is next year, and every month in crypto feels like a year. And so the time that you lose between now and when that shift will happen means that a community could gain enough both community followers and traction to overtake, quote unquote, I don't even think overtake's the right word, but find its own niche that might be as powerful as Ethereum. But I always think about the Vitalik has this scalability trilemma where it's you get 2 out of 3. You either get security, scalability, or decentralization. And so you can talk about, you know, how many protocols are actually really decentralized. And so like, how do you get all 3 will be interesting. And do you even need all 3? But I think it'll be, especially with metaverse and NFTs being so popular now, like what is the blockchain for that. And with Ethereum gas fees being as expensive as they are, how scalable is OpenSeas and inclusive versus like an NFT marketplace that's built on Solana?
And I think this goes back to the first conversation that we had is ultimately, what do people care about? Do they just want to use a product and call it a day? Are they going to worry about whether it's going to be on Solana or Ethereum? And in my high level, thought process is it's probably not going to be an issue. Like, people aren't going to care where it comes from as long as they can use a product and it works well for them. And another data point I want to throw out there is that, if you look at just how many lenders there are in the US, there's over 5,000 lenders. So of all different types. So I think, we're kind of going through a phase of just accepting the fact that there's gonna be more than 2 lenders are gonna be on Ethereum. There's gonna be many of different types of use cases, just adding to what I mentioned earlier.
Yeah.
I'm just going to throw in and say that, I think that in terms of, putting in terms of losing market share or being overtaken is not, I don't think it's the way to look at it. Like, this is, when you take a step back from just DeFi, this is where like the new internet's being built. And so, we're not going to find, like, all of these blockchains are going to find, not all of them. Some of them will not find product market fit. But we're gonna see the use cases on these chains evolve as we kind of settle in. I do anticipate that Ethereum and the EVM compatible chains are going to be at least the innovation center for the near term, just because there is no developer community like this. There may be institutional adoption going into places like Solana for those those things like throughput, which brings up to Aya's point about what Vitalik has said. He has said consensus algorithms are not designed to be fast. They're designed to be safe and secure. And so Ethereum, no matter how it evolves, is never going to be the fastest. And so it might not be compatible for that particular use case. But I think that it will remain the innovation engine.
Okay.
Yeah, and maybe one thing also to touch on that bridges a lot of that is interoperability. And that works on both in 2 ways, right? So one is there's companies that actually translate smart contract language across different chains. So on the developer tooling side, there's a lot of sophistication that's being developed. And then you have interoperability networks in between these different protocols that we already see in different types of trading pairs and things like that. I think what I also find super interesting on DeFi is on the other side of it is all these different shops offering different yield. And so that's also kind of curious, right? Like, so we're playing with it a little bit with our own treasury. We're like, okay, we're giving bits and pieces in different pools and see what comes back. And there's currently no rhyme or reason really to it. Like, kind of you have small players offering double-digit yields and then big players and it fluctuates a ton. I mean, the market is still all over the place. It will be super interesting to see if, I'm curious for you guys, do you see that even out? Do you think that's going to be a much less big bandwidth of like, hey, this one pool in this one company gives us X and we all rush in there and then that changes and it's the next one? Like, what do you guys think about that? I'm curious, just since you guys also provide services like that, maybe Aya, I'd be curious to see what you guys think about that. Like,
Imran, I saw you unmute yourself. You go first.
Go ahead. And then I'd love to just piggyback off what you said, Aya.
Sure. Yeah, so 100%. I don't think these yields it's why you have the yield farmer, right? First off, there aren't enough minutes in the day to actively move money in and out, calculate your impermanent loss, and then like track the yield across these different pools, figure out, how much fees are you paying in and out. It's a full-time job. And so one, how many people have the time to do that? And two, to your point, I think, we'll see this converge over time. But it's part of like the go-to-market strategy, right? It's what gets, it's the point that was mentioned earlier, which is how do you make this sustainable, where whether it's you get, a token drop, an airdrop, and suddenly you're a shareholder of the protocol, and so you're inherently interested because you hold a value of the project, or you launch other pools across other tokens, across other companies, and convince other additional industries to, maybe within gaming or whatever might be next, to build on your protocol. But yeah, I don't think this will stay forever.
Do you guys offer yield pools for institutions, for example? Like, and then do you run your own, or do you then parcel those out across different pools and come up with an average, or how does that work for a large player like you guys?
Yeah, that's a good question. We should definitely have this conversation offline, because I think there's a lot of room we could work together. But we currently don't offer yield directly. We're obviously exploring staking like every other centralized player in the space. But I think that's definitely something institutions want to get a hold of.
Yeah, I'll just add a point here. So we work with early stage founders, and we work with them on their token economics and their kind of like community bootstrap strategy. One thing that we advise against is giving up so much of your tokens or equity as you're looking to like bootstrap your community, because it's really important to use those tokens as a way to keep those, or acquire a customer and retain that customer. Versus, as you mentioned, Konstantin, like pumping and dumping, sort of, right? I mean, you're just going out for the best yield. That's being opportunistic. And so what we're now working on is ways to include new token offerings into new products that would help people think about just using our product even after the token incentive is done. So, you see UMA protocol that's done this really well. Ribbon protocol also has done this really well, which is they've created incredible products that have incredible yield even without an incentive, and they use the incentive as a way to just kind of acquire new customers. And we've seen this previously with Web2 strategies, which is like, hey, I'm building a Web2 company and I'm going to spend X amount to get, advertisements on Facebook and Instagram and etc. So if you think about it from the same philosophy, it's the same thing, right? So we're working very closely with founders to start to think about efficiently using liquidity as a way to grow your customers and acquire new customers.
Okay, so my main question is, what are institutions looking to do within DeFi? So we've mentioned a range of things. We've mentioned kind of just buying DeFi tokens, then maybe like engaging in governance. Then there's staking, lending, getting yield, and even more complicated DeFi stuff. Like, kind of how deep are they looking to go right now? Who wants to come in on that?
I can quickly touch on it. It seems like you got the whole gamut almost in there. But I would only say it really depends on the background of the trading team. Dependent if, again, this is all dependent on risk profile. If they're comfortable with trading on offshore exchanges, they may be engaged in derivatives and hedging those derivatives in like basis trades, or maybe trading option strategies on top of those. So the trading can be just momentum or higher. Again, I don't think like yield farming, as defined as just actively going through these different pools, is really where these institutions are playing. It's more along the lines of staking, at least from the conversations we've had. And then everyone's really focused on futures. If you look at GBTC or the DeFi trusts that are supposed to launch as well, the Bitwise's index and different index Coops index. I mean, these are organizations that get a lot of engagement from institution. It's more momentum, I would say, and I wouldn't even say I haven't seen as much engagement. Konstantin brought up the different personas. So for crypto native, you'll see maybe more engagement on the actual protocol level with voting and engaging with the DAO, the decentralized organization. But otherwise, I would say it's more momentum and yield generation.
I just have a question. You touched on interacting with the DAOs. To what extent are we seeing those interactions? Like, to what extent are institutions actively participating in DAO governance? like just in your experience so far?
Yeah, Imran, I'd be curious to, because you're probably more focused on this. I think Sushi was a great example of institutions engaging with the DAO, trying to raise a strategic round from institutional investors, having that basically struck down by the community, and then these institutions having to engage directly with the community to figure out, a feasible solution, which in the end ended up being kind of cards off the table. But Imran, I don't know, you probably have better examples.
Well, just adding to some of your examples, recently, we're starting to see more and more venture funds like Lightspeed and more traditional players getting into the space by interacting with DAOs. So USV actually, their last, if you read like Fred Wilson's blog, his last blog, his first investment was into a DAO, where there wasn't any paperwork. He just sent $1 million and he got X amount of tokens in return. And so we're starting to see more and more of these kind of venture funds starting to interact with DAOs. In terms of like actual institution adoption, I'd say we're still earlier on in that like kind of phase, but I would say probably within the next few months we'll start to see more and more institutions at least working into getting like an investment into a DAO like Sushi or Uniswap and etc.
Yeah, well, one thing I want to highlight that I saw was really interesting. A16Z Andreessen, they published actually an interesting little report in how they think about their responsibility of an investor and how to delegate into things like Uniswap and the criteria they're looking for as an institution to actually find that bridge of aiding the actual community as well as securing yield. It's rare that you find investors that actually have that mindset, frankly. But I thought I just want to reference it because they open source their research, right? So something to look at and read if you're interested. I thought that was kind of insightful and interesting to see how they go about it. I think they dropped that they dropped a mic on that yesterday.
Yeah, it was really cool. I'm sorry, go ahead.
I think that's quite interesting because we saw there was this DeFi lobby group that got $20 million from the Uniswap DAO, and it was voted through from all these student lobby groups, and people at the time assumed Andreessen Horowitz was potentially delegating to them, and then they come up with this blog post later saying we delegate to these student organizations. So it'll be interesting to see if this vote was passed by effectively one organization, one VC firm.
Fascinating. I mean, there's so much there, right? Like, I mean, we've seen such crazy stuff in the past, but I think it's. I have to say, I'm pretty impressed with Andreessen. Like, I think that's been a really good effort, and also how they publish their thinking here is pretty interesting. They're obviously spinning a big wheel, so they don't have to hustle for this sort of individual, like, hey, I want to flip and turn and do stuff. But it's interesting.
Okay, and then one big issue for institutional DeFi is compliance. Like we mentioned earlier, compliance and security. But in terms of compliance, DeFi protocols right now aren't exactly suited for compliance. And then what we're starting to see is new initiatives that are saying we want to create permissioned lending pools within DeFi where you have to be KYC to access these lending pools. The question is kind of, is this the future of DeFi? Like, are these going to become much more common? Is this going to be successful? What do you think?
I mean, we run some of those, or we're thinking about it. I think the answer is in the mix. Obviously, that'd be terrible if that's what DeFi remains solely. I do think there's thought to be paid into how do you bring DeFi to Robinhood, right? Like, so how do you enable 50 million users who might not be super crypto native to participate and benefit from DeFi? And some of these on-ramps that currently exist are regulated, and they could be really important enablers of this. And so how does that work? So I do think those are interesting models. I think I just haven't seen anything done yet that works, right? So kind of sort of a rocket pool for institutions where the liquidity comes from institutions where every dollar is KYC'd. In theory, you have permissioned nodes that can KYC every transaction if every dollar is KYC'd. But can you create pools that use the technology of DeFi and the DEX type structure in a regulated manner, I think that's interesting. That's an interesting exercise. I think you probably would have to copy the whole setup. And the fun part is you can, because there's a lot of A/B testing being done by really community-driven approaches, right? So I think you'll have some institutional pools, you'll have user-driven pools, and ideally there's a balance of both. So my view on it. A little selfishly, obviously, because on institutional pooling and stuff, it's easier for us to make money. But I do genuinely think that there's a benefit to it, potentially, if you can get institutions to pool resources together and play. And they've done that via other protocols like Figure and even R3 Quarter. Who knows what's happening there? There's been examples where they've tried to do certain things. It's just unclear on where those projects are, really, from my view. But again, I'm not as knowledgeable in the space.
Anyone else want to weigh in on that?
I mean, I to your question as to whether or not it's the future of DeFi, I mean, it's definitely the future of algorithmic finance, for sure. To whether or not it can be properly referred to as DeFi is anyone's guess. And it is a distinction with a difference. Like DeFi is by its at its core permissionless and non-custodial. Where users and individuals maintain control. Once you get into permissioned pools, it's obviously no longer permissionless, and it's so there is a certain degree of gatekeeping involved. But I think that to Konstantin's point, both of these things can absolutely coexist and should coexist. The issue that we're going to get that we do get into is and we get into the slippery slope is like, does this become the way forward for everything in DeFi? Is this the way we're going, and we're going to be KYCing everyone with like all of these reporting regulations on non-custodial service providers, and then in the end we're just recreating the industry that already exists on the blockchain, because that effectively will like put a damper on innovation and growth.
Partly, right? Like I would argue the other side of that, just basically because decentralization obviously is a philosophical structure. A group of institutions can also be decentralized, right? As long as the overall ownership of a pool has multiple different potential interest points, right? And so I think the question is, can you structure something where there's certain institutional guarantees and it ties into existing financial networks for particular use cases, and that could be the less high yield option, where knowledgeable users dive deep into running and go deep into the fully decentralized world where they can play, and then there's a sort of abstraction there. But the technical innovation isn't just in the governance, is sort of my point here. Within blockchain and DEX type infrastructure also is cutting out the middleman, and ensuring that more of the value chain remains in the value pool. You can do that with institutions in theory, depending on how greedy the institutions become. And so you need both, right? Because you need the competitor to the institutions, so they use the technology in a decent manner, I guess.
Okay. And then let's come to security. So according to the Blocks data dashboard, shameless plug, there have been $400 million in exploits, DeFi exploits so far. Are institutions concerned about getting involved potentially with a lot of money in something so risky?
I mean, yes. And then I leave it for someone else to provide answers. I think legally, we've heard a lot of problems for people who, if you put principal at risk, right? If I'm an institution and I'm investing in something where suddenly, hey, oops, $500 million just went because there was a security risk, liability is a big issue for some of those guys. I don't know that landscape too well. I have to defer to the other guys.
Yeah, I mean, I can give you a quick high level. Like opportunity, like there's a lot of risk involved right now for institutions with DeFi, capital into DeFi, but there are a number of safe ways to do it today. When you look at kind of like the long-term like DeFi protocols like Aave and Compound, and maybe like and Synthetics, they've been battle tested. Their smart contracts have been battle tested for over 3 to 5 years, right? And so they've been around for a very long time. The community trusts them. They haven't had any major breakouts in terms of hacks, and so generally speaking, from a high-level perspective, institutions are decently comfortable using those types of protocols. Now, when you think about newer protocols, there's a high amount of risk because obviously there's economic hacks that happen over time. And so you have to kind of think about which protocols you'd like to leverage to get the yield that you're looking for. There are a number of startups that are building in the space that are providing, ratings for DeFi protocols. And then those ratings are, interestingly, they're pretty active. So they rate the smart contracts, who audited it, the types of vulnerabilities they found, and how were they proactive in regards to solving those issues. And there's real-time kind of analysis that are happening as well. So there are some DeFi companies that are building a space that are actively providing monitoring services, or will be very soon, so that institutions can feel comfortable in providing liquidity.
Yeah, the other thing I'll add to that as well is bridges has been one of the weak points too, where we've seen a lot of hacks. Anything that's non-custodial, right? So you have to really research, where is your money being held? Do you have the keys? And then the other area where we've seen a lot of hacks is also Binance Smart Chain. And so how centralized and audited, to Imran's point, I can't stress this enough. There's so many people who allocate money and have no idea if the smart contract has been audited. And it's, that's such an important part of launching. And then another thing that we've seen is, these protocols will put up money for hackathons for people to hack their own protocols. Those are always great as well too, just to find bugs. And so like how much of that has a protocol gone through? And then to Imran's point, it's always a pity when you have, these massive hacks taint, I would say, like the headlines in terms of like how great the underlying really is. We have had protocols that have been battle tested. And so those are typically also the ones that institutions are engaging with, as opposed to, the ones which have either are newer, have less 24-hour trading volume, or haven't been audited.
Yeah, and auditability doesn't stop at the smart contract, actually. I'd say, like, we have that a lot too. I mean, it's one of the burdens we have as a larger scale infrastructure provider. We obviously are ISO compliant, run security audits on the tech all the time. And so we're externally certified and audited. We publish audited financial accounts as well. And so looking at the underlying entity that you're working with, either for node or custodial structure, is also important. People are then surprised that, hey, I've been with this entity, I've heard about it forever. Well, it's been registered in San Mateo, doesn't have a governance body, and the guy ran off with the money. I mean, that can happen as well. It's a very intransparent space, and you got to do your research and figure out what your risk profile is as well, obviously. And so it's always depends. Do you put all your eggs in one basket, in one platform, in one provider, or do you diversify, et cetera, et cetera? But there's a lot of education that needs to go into the space, and a lot of standards that need to be put into play. I mean, we're just waiting for the next big hack, right? Like, I mean, it's going to happen, like it's just the statistic certainty. And so,
Absolutely. And I think that it's also important when talking about auditing is like knowing whether or not a protocol has been audited is important, but understanding what's in that audit is
right.
Another thing entirely. And there are a number of projects that have, historically, like use their audit as a PR tool. Like, we've been audited X amount of times. Well, who audited you, and what did they say? Just because you've been audited doesn't mean that no vulnerabilities were found. How are those vulnerabilities being addressed? The one thing I would say, Konstantin said, Konstantin ended on a little doom and gloom note, like we are just waiting for the next hack. But there is a silver lining there. I think that people, as they spend time in the space and the space matures, are understanding these vulnerabilities more and more, and that's why you see so many of the battle-tested protocols like Aave and Compound getting the kinds of liquidity that they're getting, because they are battle-tested, they are trusted, and the team is trusted. And then on in the sort of less savory aspects of say the poly hack that recently happened, that was obviously regrettable, but those funds were recovered, I believe, mostly in full, and I don't even believe that they needed to get the authorities involved. So it does. I hope it is reassuring that this community has shown the ability to police itself to a certain extent, and I think that should be reassuring to at least some investors.
Okay, cool. Well, we've hit that hour mark, but thank you all for a really interesting discussion. Yeah, it was a great panel. Thanks, everyone.
Thanks, everybody.
Thank you.